Hello, everybody. Thanks for Jackson CPA here. Another video for you. This is part two of the series on money saving strategies you're not telling your client, which is a presentation that I gave along with my co-host Eric Pierre CPA at the County Web Summit back in early May. And so today we're talking about part two of that presentation, which is going to be talking about self-directing your retirement accounts, HSAs, all that kind of stuff, which we talked about HSAs in part one, just FYI. So this is how you can actually exponentially grow that HSA into a massive tax saving vehicle for your retirement and for your healthcare needs. Okay. And so if you want to learn more about how to self-direct your retirement accounts, then you should definitely stick around. We'll be right back in a second. Talk to you soon. All right, everybody, and we're back. So today we're talking about putting money into retirement accounts, HSAs, that kind of stuff, and self-directing it to help it exponentially grow. This is a way that you can get massive returns inside your retirement accounts. And the great thing about retirement accounts and health savings accounts and covered out IRAs and all that kind of stuff is you don't pay taxes on the gains that you're making over time as long as you use it for eligible uses from that account. And at some point, if you are using a Roth IRA or a Roth 401k, you won't even have to pay any taxes on those gains at all. Whereas if you're using a pre-tax or a traditional IRA, then you will have to pay tax on the gains at some point when you pull the money out. However, if you're using that Roth, powerful. Same thing with HSA, powerful. There's no tax as long as you pull it out for medical expenses. So today we're talking about that. Okay, so as with the last presentation, here's a little slide about myself. If you care to take a look at that, you can pause the video and read through it, blah, blah, blah. If you don't know enough about me by now, well, welcome to my channel, because this is probably one of your first videos. So, and this is about my co-host that we did the presentation together. So I want to give him his props for putting it on and getting us on the Accounting Web Summit schedule. And so Eric Pierre CPA, he's also the co-host on the CPA Huddle podcast. And so if you haven't checked out that podcast yet, highly recommend you go out and do that. Okay. And then here's a little disclaimer, just as usual. With anything on the channel, obviously, that I'm giving, it doesn't constitute tax advice for saving yourself from a tax issue. If you really want to protect yourself, you got to engage us so we can give you some written advice, and have you become a client and get you safe in terms of what you're doing from a tax standpoint. Okay. All right, let's talk about the topic. So for the topic today, you have the ability as a taxpayer to basically direct your investment into whatever you want to do. And this is for 401ks, IRAs, Roth IRAs, after-tax IRAs, traditional IRAs, pre-tax 401ks, after-tax 401ks, Roth 401ks, health savings accounts, covered IRAs, and defined benefit plans and pension plans, just to list some examples of what you can do this stuff for. Okay, so you have the ability to invest it in whatever you want to invest it in, with the exception of certain things, which we're going to talk about on the next slide here, that are prohibited. Investments in your tax deferred or tax advantage account. And so you have to be a little careful with some of those. But as long as you follow the rules, it's a great way to make some significant gains. Okay, so things that you can do: you can buy a house and rent it out. You can invest in a friend's or distant relative's business. You can loan some money to friends or distant relatives. As a taxpayer, you can buy a boat and rent it out, and you can buy precious metals. Now, for the precious metals, I will caution you, there was a recent court case, and frankly, any real professional would have advised you not to do this anyways. But whoever they got that advice from is an idiot as far as I'm concerned. But basically, you cannot store the precious metals in your house, okay? Or your business or anywhere else that you have easy access to, right? It needs to be in a safe deposit box, or with a third-party custodian of some sort, where it's there, being stored somewhere else that you're not technically accessing on a frequent basis, okay? And so if you do that for precious metals, it's a great investment. All right. Now here's some restrictions on things that you can't do with these types of accounts. Okay. You can't invest in collectibles such as art, stamps, coins, alcoholic beverages, or antiques. It's not a collectible. All right. Life insurance, can't invest in that. It has corporation stock, not investing in that. Any investment that's not allowed under federal law, can't invest in that. Like a marijuana dispensary, for example, even though it might be legal in your state, you can't technically use your retirement funds to invest in it because it's illegal under federal law. All right. Prohibited transactions with certain persons, okay, which include the taxpayer spouse, children, parents, grandparents, grandchildren, and certain business partners. You cannot invest in those types of people's businesses, okay? So basically, it's your ancestral and lineal descendants. So ancestral go up the line, lineal go down the line. All right. All those descendants you have to be careful with. Okay. Funny enough, it doesn't include your siblings or your in-laws, like your mother-in-law, father-in-law. I don't know why, but when you go down, if your parents were trying to invest in your spouse's business, for example, or something like that, that would not be allowed. So it's weird that sometimes they get you by marriage and sometimes they don't. I don't know. But anyways, so those are the things you have to kind of be careful about. If you do that, you avoid any penalties. But let me just explain what the penalties are if you do one of those. Okay, if you do a prohibited transaction, and I actually had a client who did this recently, and I feel sorry for her because she owed like almost, I don't know, a couple $100,000. Let's just say, and I shouldn't say she owed. She did a prohibited transaction that was worth a couple $100,000 roughly, and there was just no real good, situation that made sense, in that case. And unfortunately, the moral of the story is you have to kind of report it and pay the taxes on it if you want to protect yourself. And so, it's just one of those things. I mean, you have to be careful, okay, with these types of things. And that's why you want to seek advice from a professional that understands what's going on with this type of stuff to make sure you protect yourself. Okay. Now, for 401ks, you can actually be your own custodian or trustee, is what you're called in a 401k. Okay, but you have to be careful to know the rules again because of prohibited transactions and all the other reporting and all that kind of stuff. Got to make sure you know what you're doing there. So you'll want to get somebody involved to help you out. For the IRAs and the HSAs, the taxpayer must use a custodian for those types of accounts. Okay, the taxpayer can roll over funds from any other tax-deferred accounts into these various vehicles. Okay, there's a lot of different ways you can roll over funds. If you ever have a question on how you can get stuff from a not so friendly investment strategy to something different, let me know. Taxpayer can have both Roth and pre-tax accounts. Okay, the taxpayer can backdoor contributions if the taxpayer makes too much money to do a direct contribution to a Roth IRA. The taxpayer can buy rental real estate using a non-recourse loan, which allows the taxpayer to buy more assets with less cash inside the 401k. Now, the reason I say 401k is because there's not this little pesky thing called unrelated debt finance income like there is inside of an IRA or an HSA. If you buy real estate inside of an IRA or HSA with a loan, you have to be careful because you might have some UDFI that you have to pay. So, but other than that, I mean, it's just a great opportunity for you here. Okay. Now, certain businesses that are owned by the IRA, you will also have to pay UBIT taxes, which is unrelated business income tax. Okay, you'll have to pay some taxes on that type of activity if you are operating a business inside the retirement account, like a for-profit business. You have to be a little careful with that. Okay, but other than that, I mean, there's a lot of great options. I mean, you can all the stuff that we talked about. You can invest in crowdfunding campaigns. You can invest in real estate syndication. You can invest in a number of different vehicles. I mean, you can do loans to business owners. You can do all kinds of stuff. I do a few different things inside of my retirement accounts, which is why I talk about this stuff because I actually love it. And I've been making decent money off of it. So, I'm one of those people that is getting outpaced returns. Okay. So you just have to think about how you want to invest your money and then use it wisely. All right. Um, Other things to think about when you're self-directing. Okay, you can have LLCs within the tax deferred account, meaning you can have underlying LLCs that own your real estate to help protect all your other assets and investments that are inside the accounts in case something goes wrong. The taxpayer can have a 401k loan inside of a 401k account up to $50,000 or 50% of the balance, which is standard type rules. Okay. Depending on the size and activity, you may have to file a tax form at the end of the year, either a 5500 or a 990T, sometimes 1099s. Just depends on what you're doing in that activity. Okay, so in some cases, you might have to file some forms. Taxpayers should update the plan documents annually or at least review for the 401k plans. Okay, and like other retirement accounts, penalties do apply if you do an improper distribution before you reach retirement age. All right, so that's going to be the case with any type of retirement account, even if it's self-directed or not. Okay, you're going to have those issues. All right, so that's nice and short and sweet. That's the topic for today: self-directing your retirement account. Again, just raise the surface on this stuff, but it's such a powerful, powerful tool. If you saw in part one when I did the HSA scenario, and I said 7% annual or 7% monthly compounded returns and 10% monthly compounded returns. Just imagine if that was 20% or 25% compounded monthly returns, or even compounded annually returns. I mean, either way, you'd have some massive, massive returns in that type of account over 10, 15, 20 years or more, which a lot of people, if you start early, you can get to that point. And so it's just a phenomenal, phenomenal way to make money, while you're sleeping and in a tax advantage way. All right. So think about this stuff. And if you have any questions, feel free to reach out to me. Here's the contact information for Eric Pierre CPA and myself. Again, we do a podcast together called the CPA Huddle Podcast. Feel free to check it out. Leave some comments, give us some questions, and we might even talk about you on the podcast if you shoot us a question about it. Okay. Hope everybody has a good one. We'll talk to you some more later. Peace.